everyone, a very good evening. You're watching The Money Show on ET Now. I'm Mubina Kapasi. This is your daily dose of personal finance that you need to keep note of. So let's talk about the topic that we are going to be discussing today. Remember that at 5:30 p.m. we will be slated to receive the GDP growth number, or the gross domestic product. Now this is relevant for each and every one of us because it essentially tells you what the economy has gone through and what the future course of action will be for the government, for the RBI as well, to essentially ensure that the country is growing in a healthy manner. So whether it's interest rates, whether it's inflation, all of that, are dependent on this GDP number among various other macroeconomic factors. Not to mention, of course, India's equity markets as well. Well, most of the times do tend to reflect what the economy state is. And unsurprisingly, with the COVID the COVID-induced lockdown essentially cutting down India's economic activity, factory output, we are expecting a massive decline in GDP, 19%. And remember, if it does go to 20%, we often say that a country has gone into recession. So it definitely sounds like quite a scary word, right? When you say that the country where you are investing your money in, right? When you buy equities, when you buy equity mutual funds, you're essentially investing in the future of that country. And when that country tells you that, look, because of XYZ reason, we are in the midst of this recession of sorts because our GDP has declined by 20%, it definitely is a bit perturbing. However, should you really be worried about that entire bit? I have with me one of the foremost heads of private wealth management, Mr. Anupam Guha of ICICI Securities. Mr. Guha, many thanks for joining us today on ET Now. It's a pleasure having you with us. So to start with, Mr. Guha, let's understand then that many a times, when we look at our investment portfolios, we are really disappointed with the kind of returns that we are witnessing. Firstly, is there anything called as a crisis-proof or a recession-proof portfolio, or do you think that that's just hypothetical and, to be honest and realistically, a portfolio will go through its ups and downs?
Thanks, Movina. Thanks for having me at the show. You see, you would have your, set of volatility given, this pandemic, which has been unprecedented, right? But when you construct a portfolio, and especially for, the clients that we manage, our approach has always been that how could we build a more robust, and a well-diversified portfolio. And that is where I think this concept of strategic asset allocation comes in the picture, right? If you only were to invest into equity will always have its own set of volatility, and it's just not about this pandemic, but across all through history, you would see markets having that element of volatility. And if as an investor, you're not comfortable with volatility, then maybe equity as an asset class is not something that's for you. The other thing is, obviously, if you were to increase the time horizon, this volatility obviously goes down. And hence, for people to construct the portfolio, I think what determines a portfolio, an ideal portfolio, would be basis, some of these factors like what is the risk appetite that a customer has, or say, for example, what kind of return expectation that, people have, or say, for example, even, your liquidity profile, right? So a whole lot of people, when we build, our portfolios, our entire engagement is on some of these parameters like life stage goals. So say, for example, if somebody has, a marriage coming in the family, or say, for example, a property that one would need to buy, you will have to manage those cash flows. And hence, looking at all of these, you really build a portfolio. Having said, Movina, an ideal portfolio, depending on what the customer wants, will have components of, or what are the constituents of a portfolio? It would be equity, it will be debt, and then it will be, an alternate, like, say, for example, a gold. And depending on what the customer preferences and his risk appetite, you construct a portfolio amongst these three broad asset classes. And given how the pandemic has been, in our engagement with our customers, we are also, suggesting our clients to have a slightly higher amount of liquidity or cash in their portfolios, given that, the market with its volatility is also giving you opportunity for rebalancing investment, and hence, having a fair bit of a 5 to 10% cash in your portfolio is a good strategy given how it is. So, Movina, if I can just extend my thought process, when you spoke about that, how do you create a portfolio which is which is, say, for example, more solid, more resilient than how we see the stock market. I think if you were to look at the data point, right? If when the first quarter came in, a whole lot of clients actually panicked and sold off their equity allocation and moved into fixed income. So fixed income sales really went up drastically. Given now, if you were to look at, because the yields on fixed income portfolios have gone down, maybe at a 5 for a AAA paper at a 2 to 3 year modified duration, an investor is making 5.5% yield. So a whole lot of our clients are thinking that, boss, how do I really diversify my portfolio? Also, if you were to look at gold as an asset class, right? Given that if you hear the commentary, globally we are talking about negative interest rates, real negative interest rates. In many places, it's almost zero interest rate. So if Fed is giving a commentary of reduced, interest rates, etc., then and given the volatility in the market, gold will continue to have favor. And that is where we've seen a whole lot of our clients really diversifying some of their portfolio into gold, and gold sales have surged. So just to summarize whatever I have spoken about, if you really will have to create a portfolio, then it will have to have, components of understanding of what the customer needs, be it his risk appetite, his liquidity profile, and his return expectation. And basis that, you build a portfolio which could be completely into equity to a more balanced type of a profile who would have a combination of equity, debt, gold, and a little bit of cash. Given it's a tactical call, given the pandemic. Mubina.
Okay. You mentioned, yes, thanks for that answer, Mr. Guha. You mentioned that, of course, if somebody does not want volatility at all, then they shouldn't invest in equities. But, if you want a good return as well, volatility has to be a part and parcel of your portfolio. However, let's talk about those individuals, and many of our viewers, are saving with this one goal that, they want to create wealth for the long term, for retirement. So basically, they have really long-term goals, right? Now this crisis has hit us in the middle of us sort of making our way towards that goal. Let's say we have, maybe another 10, 15 odd years to go. Do you think that then every single time that a crisis hits us, even if our goal is a little further away, we need to make adjustments, like, for example, rejigging our investment portfolio, put heightened emphasis on mitigating volatility? Do you think such moves need to be made, even if, let's say, our financial goal is some time away?
So, you see, the markets are dynamic. The world is, the economy is dynamic, and some of the events that have happened are unprecedented. So, to really review your portfolio, I think it is extremely important. You may not want to change your overall strategic allocation, but tactically you will have to, review and do course correction, and that's extremely important. Mubina, you spoke about the fact that, maybe the objective with which you are saving, is a little while away. And within that, would one needs to relook at your portfolio, rebalance your portfolio, and do course correction? The answer is yes. So while, I'll give you a couple of examples. Gold as an allocation, I think, so say, for example, people would invest into gold because people would see it as a hedge, right? And maybe a 5% allocation in a portfolio. We are saying, while you have a strategic 5% allocation in gold, but tactically, given the outlook in the market, one may want to increase it to maybe a 10% or 15%, right? So either be it the gold ETF or the sovereign gold bonds, one could increase tactically your allocation to gold. Likewise, say, for example, you have made an investment into debt. Now, if those are papers that you invested into with an allocation, I think it's worthwhile to maybe continue those investments, because ideally in the current market, given that the yields have gone down, you may want to figure out that whether those are roll down strategy, what kind of credit paper. So say, for example, a whole lot of our investors had taken, say, credit call in their overall allocation. But given the crisis, credit has taken a beating. So you may want to figure out that whether you want to take a credit call or you would want to move your investment from high credit into AAA papers, right? And those are the tactical, changes that you will have to do. You will have to have a microscope to figure out and see what are the constituents of our portfolio. So while on the debt side, strategically, you're not shifting, if you had a 30% allocation to debt, you may not want to change your allocation to debt. But within that, you may want to do all of these tactical changes in your portfolio. Likewise, say, for example, if you're a new investor and you're entering the market, right, we may not suggest people to really take a duration call, but we would maybe suggest customers to take maybe with a 2 to 3 year horizon in the market. Likewise, in equity also, while you may have an allocation to equity, but then say, for example, you had you had invested into an airline stock, or you had invested into, through mutual funds also, right, into sectors like, which are, say, high levered, cyclical, capital good, real estate, and some of those leverage this thing. You may want to rebalance your portfolio, right? If you see in the last 3-4 months, the sectors that have done well are really the defensives. So pharma has done well, IT has done well, FMCG has done well, telecom has done well, right? And if you are underweight to some of these, sectors, your portfolio would have underperformed. Likewise, you also need to look at the future in terms of what's really going to, move the market, and hence you will have to rebalance. So to sum up your, the answer, Mobina, essentially, while strategically you may want to continue to have those allocation to various asset class, you would still need to look at your portfolio minutely, closely, and that is where people like us come in, financial advisors, relationship managers, wealth managers come in, because we are then able to work closely with our clients and guide them in terms of, tactical rebalancing in the overall portfolio.
Overall, the skeleton of your portfolio could remain absolutely the same. But yeah, sometimes a crisis could call for some tactical changes and that's really where, like Mr. Guha mentioned, is, where financial advisors like him essentially step in to guide you through that complex world. It could be really tough, right? I mean, who knew that pharma and IT would be the sectors that would really lead the markets in these last 6 months, when prior to these 6 months, these were really, the slow movers and the underperformers, especially pharma. So that's where, financial advisors like Mr. Anupam Guha really do step in. Okay, so the other big point that people are asking is that this crisis has of course caused a lot of people to lose money in some stocks, in some mutual funds as well. And if you look at it in March, literally people just wanted to sell out their entire portfolio and leave, right? But since then, look at the rebound we've witnessed. So we know for a fact that that may not be the right thing to do. However, how do you identify, Mr. Guha, when a certain stock, when a certain asset is a complete dud in the portfolio and you must exit? Or rather, should we say, how should you not have that bias that, no, this stock will recover or this asset class will recover?
Sure. One is that if you are a sophisticated investor, then you anyways, can read the market, and take those calls. But if you are not, and if you also do not have the time, then it is best that, one should work with wealth managers because, or asset managers, because that is the full-time job of people like us, and we are able to guide our clients. Now, if you were to look at, and Mubina, you're right that when the crisis had struck us in March, April, everybody just wanted to sell off their portfolio. While, 4-5 months down the line, I think nobody had even imagined the markets to be where they are, right? And that's the beauty of market, that it can surprise you all the time. I mean, you look at it, there is ample liquidity. You look at the way the commentary, the Fed commentary that's been there. You look at even our Q1 results that have come in, right? The June results. In fact, it's surprised because it's beaten the overall subdued expectations that analyst and the market was looking at, and hence I think one needs to be patient. And secondly, I think from an investment perspective, when the market's corrected, and I know of a whole lot of our clients did tactically move some of their money from, say, for example, from debt to equity, because they were able to see that which are the sectors, or within equity, they rebalance their portfolio because there were certain sectors that seem to be doing better or would benefit out of COVID, right? So whenever a disruption like this happens, I think there are some sectors that gain disproportionately and the others suffer. And that is the rule of the market. I think the ability to catch those trends are important. So people who, had sound balance sheet, low debt, low leverage, people with strong digital capabilities, I think are, and then obviously, as I mentioned, pharma, IT, those kind of defensive sector gained disproportionately versus something else. So if one way to look at their overall portfolio, one is that if fundamentally you believe that on a macro basis, those sectors have significant headwind, you need to cut loss and move on. You also need to pick up the winners of tomorrow. I think those are also important. And as I mentioned, that tactically you may want to, depending on the macro view, be it gold, be it debt, be it equity, you may want to toggle between one sector to other, and that is how you kind of rebalance and move your money from one, within the same asset class, from one product to the other, or from one stock to the other, or from one scheme to the other. I'll give you a couple of more examples, Movina. So you have in mutual fund something called as, say, for example, focus funds, right? So these are typically 20-30 stock portfolio within the mutual fund. And if you want to take a bottom-up call, multi-cap, on good quality, maybe those are the kind of schemes that you would want to invest into. You have today what you call it as balanced advantage fund or asset allocation funds, right? So those are funds which toggle between equity debt or between equity debt and arbitrage, depending on, whether it's constituted as a debt scheme or an equity scheme, where the fund manager is taking those calls of toggle between equity and debt, depending on certain factors like price to book, price to earning.
Okay.
And depending on how expensive they think that the market is, they are able to move money from equity to debt, right? Which maybe a normal investor may not have the bandwidth or the time to really switch money from one to the other.
Be able to do.
And that is how we believe that, schemes like those are extremely beneficial, and one could, make investments likewise.
Right. Great. Okay. We would have loved to take this conversation forward even more, but unfortunately we're a bit short on time. We have the GDP number as well, like we flagged up earlier, that we are going to be talking about on ET now. So we'll let you go on that note. Thank you so much, Mr. Guha, for joining us. Well, folks, keep all of these points in mind when the GDP does release at 5:30 p.m. For now, we will take a very short break.